So when it comes to investing in general, whether you're planning for your retirement or your kids' education or even your estate planning, there are multiple options available. Okay, so I have a partnership with Aegon Research, one of the best financial advisors in Canada. And if you need any help, let me know. I can connect you with one of the best financial advisors, and they can give you the honest advice, free of charge. Okay, so I sat down with one of my financial advisor, and we went through different options in terms of investing: estate planning, kids education planning, retirement planning, and we went through some options. One option I did not know about that, and I wanted to tell you in this video. So when it comes to investing, you can either start investing into the individual stocks like Apple, Meta, Netflix, Google, Nvidia. But those stocks are all-time high, yes. But then if you look into the longer horizon, like between 5 to 10 years, and you dollar cost average regularly, over the long run, it can build equity into it. Okay, and this has been proven strategy for so many years. So that's one thing. But of course, you don't want to put all eggs in one basket. So if you put everything into one stock, it carries a lot of risk. In order to de-risk that, you can invest into different types of funds. For example, mutual funds, ETF, index fund. The last one is segregated funds. I did not know about that, so I'm going to share some details about that as well. So let's talk each of those options. So a mutual fund is basically an actively managed fund by an institution, like a financial advisor, and they publish the details as part of their marketing collateral, and they tell you, hey, where are we investing, and we are going to actively manage it, which means we can remove some assets from it, we can replace it, because we wanted to maintain a minimum return commitment to our investors, and by doing that, they charge you some fee. Typically we call it MER, or management expense ratio, which varies between 0.4 and 0.8% annually, and it is taken from the profits. So that's mutual fund, and you cannot trade mutual fund like a stock anytime during the trading hours. It has to be done at the end of the trading time, because it has to be reconciled, right? So that's mutual fund. The second option is ETF. So ETF is for some commodities that you cannot typically trade on exchanges, like gold, like real estate, like copper, oil. So what the financial institutions do, they actually create an ETF that tracks the price of that commodity. So you can trade that ETF just like in a stock on a exchange. So very straightforward. You can invest into that. The third option is index fund, which means it is a fund that tracks the major indexes like S&P 500, Dow Jones, NASDAQ, Russell 5000. So basically it tracks those major companies in the stock market. Like Vanguard has those index that you can look into it, and they also pay dividends as well, right? The last one is called segregated funds. I did not know about that. So this is typically used for estate planning, and it's very much Canadian. So it's very common in Canada. A lot of people in their 60s, they take this option. And let me tell you the history behind it. So when you take out mortgage, the banks try to sell you the mortgage insurance. They tell you, you're taking this $500,000 mortgage. God forbid something happens to you. How are you going to pay off this mortgage? Your family will be in trouble. The bank will repossess the property. So in order to avoid that situation, why don't you buy a mortgage insurance? So that's bank going into the insurance side of the business. Similarly, the insurance companies, they're trying to go into the investment side of the business. So what they do is they take mutual fund and they wrap their insurance guarantee around it, and they sell it as a segregated fund. So what it does is basically it's a typical mutual fund, but they give you two sets of guarantees. Number one, it's called death guarantee, and number two is loss prevention. So let me tell you what are they. So death guarantee means let's say you purchase a segregated fund, but God forbid something happened to you, you die, and your beneficiary, and at the time of death, the funds is losing value and it is basically below its original principal amount. So in that case, your beneficiaries will get either 75% of that capital or 100%, depending upon which options did you choose. And the second guarantee is at the time of maturity, because it has a maturity term, if the fund loses its value, it goes below its principal amount, your original capital will be protected. You can get either 75% or 100% of that fund. So those are the two guarantees that the companies are trying to give you as part of the segregated fund. But the cost here is the fee becomes expensive. So in mutual fund, there is a fee called management expense ratio, as I mentioned that. In segregated fund, it's much higher because of those guarantees, right? Typically, it's 1%, 1.5%, depending upon which company is selling you. So it's not good for everybody, right? It's basically good for people who are in the retirement or they're approaching the retirement. So in that case, they have nothing to lose. They have access to the capital. It's very liquid, and they can basically easily transfer that wealth to their beneficiaries when they die. So it's typically used for estate planning. So if you're planning, you're doing estate planning, then segregated fund is something good for you to consider. So I thought maybe it's good to kind of share with you. If you are thinking about doing estate planning or your kids' education planning or typical retirement planning, let me know. I have partnership with Aegon Research. They can help you out with that. They can give you honest advice. They can give you all the education about all these options, and you can decide which one is good for you. Okay, if you like this video, give me a thumbs up, subscribe, and I'll see you in the next video. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.